The Indian financial system remains resilient and is gaining strength from the broader macroeconomic stability. Its well-capitalized and unclogged balance sheet is reflective of higher risk absorption capacity. The NBFC sector and the urban cooperative banks also continue to show improvements. Even in such stable financial sector conditions, the emphasis cannot shift away from proactive identification of potential risks and challenges, if any. In the current context, there are four issues which I would like to highlight. First, it is observed that the alternative investment avenues are becoming more attractive to retail customers, and banks are facing challenges on the funding front with bank deposits trailing loan growth. As a result, banks are taking greater recourse to short-term non-retail deposits and other instruments of liability to meet the incremental credit demand. This, as I have emphasized elsewhere, may potentially expose the banking system to structural liquidity issues. Banks may therefore focus more on mobilization of household financial savings through innovative products and service offerings and by leveraging fully on their vast branch network. It is the first point which I wanted to highlight in the context of the financial sector. You see, as I mentioned a little while ago, the overall financial sector continues to be healthy and stable. As the regulator of certain segments of the financial sector, it's our responsibility to point out the possible or the potential areas where risks may come up. And it's our responsibility to just suggest to the banks, to the NBFCs and other financial institutions to be extra careful and to keep extra vigil on certain aspects, which is not a problem at the moment, but if unattended, can become a problem at a later stage. But so far as the current scenario is concerned, and so far as the overall financial sector outlook is concerned, I would like to again reiterate and re-emphasize that India's financial sector remains stable and healthy. Now, in this context, the second point which I would like to mention is that the sectors in which preemptive regulatory measures were announced by the Reserve Bank in November last year have shown moderation in credit growth. However, certain segments of personal loans continue to witness high growth. Excess leverage through retail loans, mostly for consumption purposes, needs careful monitoring from macroprudential point of view. It calls for careful assessment and calibration of underwriting standards as may be required, as well as post-sanction monitoring of such loans. Most of the banks are doing it, but we need to constantly re-emphasize this point. The third issue that is attracting our attention is home equity loans or top-up housing loans, as they are called in India, which have been growing at a brisk pace. Banks and NBFCs have also been offering top-up loans on other collateralized loans like gold loans. It is noticed that the regulatory prescriptions relating to loan-to-value, that is LTV ratio, risk weights and monitoring of end use of funds are not being strictly adhered to by certain entities. I repeat, certain entities. Such practices may lead to loan funds being deployed in unproductive segments or for speculative purposes. Banks and NBFCs would therefore be well advised to review such practices and take necessary remedial action. Fourth, recently there was an unprecedented outage globally which affected businesses in many countries. The outage demonstrated how minor technical change, if it goes haywire, can wreak havoc on a global scale. It also showed the fast-growing dependence on big techs and third-party technology solution providers. In this background, it is necessary that banks and financial institutions build appropriate risk management frameworks in their IT, cybersecurity, and third-party outsourcing arrangements to maintain operational resilience.
Thank you for watching us on CNBC TV18. For all news and updates, subscribe to our YouTube channel and watch us on all social media platforms.